created by Mindstick's Foundation Trust. Welcome, students. In today's explainer, we are going to cover 4 key areas: brokerage and share trading, GST on brokerage services, exploring mutual funds, and finally, calculating NAV and SIPs. Let's get right into it.
Section 1. Brokerage in share trading.
Okay, let's dive into this. You see, we can't just walk straight into the stock market and start buying and selling shares on our own. It's simply not allowed. We need registered members or agencies to execute these trades for us. We call them share brokers, and naturally, they aren't working for free, right? For this service, they charge a specific fee, which we call brokerage. Now here is the absolutely crucial mathematical rule you need to lock in your memory. Brokerage is always calculated on the market value of the share and never on the face value.
Now notice this crucial contrast carefully. The math actually changes depending on whether you are buying or selling. When you're buying a share, that brokerage is an additional expense. It comes out of your pocket. So your buying cost is the market value plus the brokerage. But when you decide to sell, the broker takes their cut before handing you the cash. So your earnings are the market value minus the brokerage. Understanding this simple logic, adding when you buy and subtracting when you sell, is the absolute key to perfectly solving any share trading problem.
Moving on to Section 2, GST on brokerage services.
Here is a number you'll see a lot: 18%. This is the standard rate of goods and services tax, or GST, applied specifically to your brokerage amount. But remember, class, this 18% is not applied to your total share value. No, it's calculated strictly on the service fee, the brokerage itself. Since the broker is providing a financial service, it attracts that flat 18% GST rate.
This brilliantly illustrates how the taxation plays out in reality. Take a look at this actual contract note from a real trade. We have a purchase of 100 shares at a market value of 150 rupees each. That brings the total share price to 15,000 rupees. The brokerage, calculated at 0.5%, comes out to exactly 75 rupees. Now look closely at those tax columns. That 18% GST is split evenly into 2 parts: 9% central GST, which is 6 rupees and 75 paise, and 9% state GST, another 6 rupees and 75 paise. Both are calculated only on that 75 rupee brokerage fee. So your grand total to pay becomes the 15,000 for the shares, plus 75 for the broker, plus 13 rupees 50 paise for the government. See? It's a highly transparent system once you know how to read it.
To solve your textbook problems confidently and to actually understand your own future trading account, just follow these 4 simple steps. Step 1. Calculate the total market value by multiplying your number of shares by the market value of a single share. Step 2. Figure out the brokerage amount using the given percentage on that market value. Step 3. Calculate the 18% GST strictly on that brokerage amount. And finally, Step 4. Find your final cost. Add everything up if you're buying, or subtract the brokerage and GST if you're selling. Stick to this methodical sequence and your calculations will literally never go wrong.
Section 3. Exploring mutual funds.
Every coin has 2 sides, right? Direct share trading can yield massive profits, but sometimes you might take a heavy loss. So how do we reduce that risk? The answer is mutual funds. Instead of betting your hard-earned savings on just one single company, mutual funds gather, or pool, money from thousands of investors. This massive pool is handed over to an asset management company. There, professional experts spread it across various schemes, like equity or debt funds. Because your money is spread out across many baskets, your overall risk drops significantly.
This whole strategy of pooling and diversifying brings some wonderful benefits. For starters, you have professional managers analyzing the market, so you don't have to stress about it. Second, that diversification naturally limits your risks. Third, mutual funds offer excellent transparency and liquidity. You can easily redeem your units and get your cash when you need it. And finally, they offer the distinct advantage of long-term capital gains, with some specific funds even giving you income tax deductions. It's just a fantastic, highly disciplined way to build wealth over time.
Let's move to Section 4, calculating NAV and SIPs.
Think of it this way: just as you buy shares in the stock market, you buy units in a mutual fund. And the price, or the market value, of one single unit is called its net asset value, or NAV. Because the market value of the shares inside the mutual fund changes every day, the NAV of your unit also fluctuates daily. So whenever you want to check exactly how much your investment is worth today, the NAV is the magic number you need to look at. The mathematics here is wonderfully straightforward.
To find your total fund value, you literally just multiply the NAV of one unit by the total number of units you own. Let's say you invest 10,000 rupees, and the NAV of one unit right now is 25 rupees. You simply divide 10,000 by 25, which means you'll be allotted exactly 400 units. Easy, right? As that 25 rupee NAV grows over the years, the total value of your 400 units grows right along with it.
Now, what if you don't have a massive chunk of money to invest all at once? Well, that is exactly where an SIP, or systematic investment plan, steps in. An SIP lets you invest small, regular amounts, like say 500 rupees every single month, into a mutual fund. This builds incredible saving discipline. And even better, investing through an SIP for the long term, like 5 to 15 years, actually protects you from wild market swings. You just keep buying units whether the market is high or low, beautifully averaging out your costs and building a solid financial cushion for your future.
So, class, we have truly covered a lot of ground in today's explainer. We've unpacked the exact mathematics of brokerage, the 18% GST applied to those services, and how mutual funds use NAV and SIPs to expertly manage risk. So I leave you with this final thought. Considering the precise costs and taxes of direct share trading versus the professionally managed safety net of an SIP, which financial path will you choose to build your future? Thank you for joining.